It's nice to have some peace and quiet in the markets for a change. US and China ease trade tensions. Company earnings are back in the spotlight. Let's look at some key developments from last week and why this may just be the calm before the storm. Let's discuss. My name is Den Slim and welcome to another episode of Monday Market Outlook. Of course, the headline last week was the initial trade deal between US and China. The two countries de-escalated trade tensions on Monday, agreeing to drastically lower tariffs. US tariffs on China will fall to 30% from 145%, and China tariffs on US will drop from 10% to 125%. While it's not zero, it is within a reasonable level, at least, to continue trade between the two countries. April CPI report in the US also showed easing inflation pressures despite Trump's tariff taking effect last month. Inflation ticked lower in April, coming in at 2.3% versus 2.4% in March, marking the lowest annual increase since 2021, while core inflation remained steady at 2.8%. April PPI inflation also fell to 2.4%, which is below analyst expectations of 2.5%, while the core PPI numbers came in at 3.1%, in line with expectations, and this was actually the biggest decline for the PPI since 2020. Dig a little deeper into the data, you will find that the sharpest drop in wholesale prices for the PPI is largely due to narrower margins, which strongly implies that producers may be absorbing a portion of the tariff-related cost increases themselves for now. But this could be short-lived, as Walmart earnings last week project that these tariff increases will begin to reflect sometime in May and in a more pronounced way in June. Doug McMillon, CEO of Walmart, said, "We will do our best to keep our prices as low as possible, but given the magnitude of the tariff, even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins." And as the numbers offered relative calm and encouraged risk on for investors, of course, the gold trade continues to feel pressure, at least in the short term. Gold futures forming what looks like a double top, punching through the shoulder here, but the rejection along the 50 EMA, especially after dire warnings from Walmart, could offer signs that gold play may still be alive, or at least consolidate along this area. The correction, of course, for gold could just be normal, because those who are long gold has been the most crowded trade since April. So we could see gold consolidating until May or June as investors brace for potentially higher inflation numbers. Meanwhile, earnings continued locally. JGS haunted by losses on their petrochem business. 65% decline in revenues from 12.6 to 4.4 billion, and a miss dragged JGS down this week. Earnings superstars were Vitarich, San Miguel Corp, and Converge. Converge winning the battle of internet providers with a 19.5% net income growth. Monde continues to report losses on the alternative meat business, and investors may have grown tired of repeated impairment losses. So Monde stock fell almost 10% on the news. Monde almost back at the 7 peso level. Meanwhile, let's look at the PSEI. The index pulled back after a sharp rally to break a 5-week win streak. As mentioned, 6,500 here is a major resistance area, where we see here the 200 EMA and the 38 Fibonacci converges. At this point, we could maybe see the index pull back to around 6,350 to get some buyers back. Hopefully, this could help the index rally towards the 0.5 fib level, which is at 6,700. But if that is to happen, index heavyweight SM needs to be in it. SM continues to trade along the resistance area here, so far the 200 EMA has provided quite a strong support. So hopefully we are seeing accumulation happening, and the test of the 920 resistance could be happening in the next few weeks. Also, second index heavyweight ICT nearing the 417 resistance zone. If you were able to buy ICT here at the buy zone at 340 or 345, this could be a good level to take some profits, maybe what, 20%, 25%, just to lock in some gains. A pullback could be possible to the 20 EMA. It has struggled to break 417 for quite some time now. There could be some profit taking along these levels. A quick look at gold shows some divergences on the oscillators. Now let's look at the 2-hour charts, right? And what we can see here is a clear downtrend on gold. So what we can see here is a clear downtrend for gold, right? It's forming lower highs, lower highs, lower highs, and lower lows. If we draw trend lines here, we can see that gold, at least in the short term, is moving along this price channel. So this has managed to form a higher low. We will see once gold hits around 3,238 if it will be able to punch through this and break the trend, or will it continue to go down after hitting the 3,200 resistance. Right now, gold plays like APX. Let's go back to the daily chart. APX breaking through the 0.38 fib. Let's wait for the 0.5 fib level here at 557, or maybe even 519 to 510. Now, Philex mining bouncing off of the 61.8 fib. This could result into a technical bounce towards around 650. Let's see what happens at that level. Interestingly, for Philex, let's look at the weekly chart. Philex did hit a major resistance area, which it hit all the way back in May of 2021. If Philex manages to recover from this pullback, a breakout of the 730 level could be a potential upside to around 930 or even 1024. So I'd like to revisit a couple of the most consistent trades that we've been doing in this vlog for the past 2-3 years. These are stocks that we've been highlighting during our early days. First is JFC, right? If you were some of the early subscribers of this vlog, we've taken advantage of JFC support and resistance levels, and look at how consistent JFC has been through the past years, right? And it's just so ridiculously easy. It's almost laughable, right? You just buy when it hits 215, buy more when it hits 204, then sell when it hits 260 and even 275, right? So it's that easy, it's that consistent, right? So what is happening right now, again, we just do a partial sell, right? When it hits right around 260, you sell 30%, 25%. When it hits 275, right, you sell 15% more. And then when it hits the buy zones, you buy it back and then you sell it again, right? So right now, what is happening, JFC again bouncing off of 204, a good entry. Of course, that was just a one-day bounce. Congratulations if you were able to get some shares here, but realistically you could have gotten shares here at 215 or 220, which are good levels to enter. 245, still a good chance to enter. The upside here could be 7% or even 13%, right? A very easy trade, right? So next we have SEC. SEC, see here, some predictable movements for the stock, right? It announces dividends on the X date, it gaps down, consolidates, moves up on the dividend X date, it gaps down again, consolidates, moves up before the X date, gaps down during the X date, consolidates. So again, same patterns here, gaps down, consolidates, moves up, gaps down. Now we are in the same situation. It has gapped down after the X date. It has moved down back to our buy zones here, 31.80 or even 31. Could be a good chance to buy. Some traders sell before the X date to avoid the gap down and then buy back at around 31 or 31.75, then sell at around 37 or 38 or maybe 35.70. So same situation here, could be a good level to enter. We are hitting buy zones here. Next dividend for SEC is in 5 months, usually in October. This is your boring, corny 14% dividend stock. Let's look at the dollar-peso exchange rate. The dollar strengthening after the US-China trade resolution, but the peso has been quite resilient so far. The dollar held support at 55.27 for now, averting a possible dip to 54.35. So let's go to the global market. So far, the S&P 500 has recovered and is now in the positive territory for this year as a sense of normalcy returns to the markets now. So investors have resumed buying risk assets, although optimism might be tempered in the next weeks following Walmart's warning about potential price hikes driven by tariffs. So the US markets closed this week a bit above the call wall here at 59.30, closing at 59.53. At this level, markets quite overbought and overstretched. So don't chase prices at this stage. Wait for the pullback to the 20 EMA. Again, we know markets will eventually revert to the mean. As of now, again, markets are a bit overstretched. Now, if we look at the sectors, let's go to the 5-day performance. We can see that the market has been rallying off the backs of solar, semiconductor, biotech, and the tech sectors. Even on the 1-month chart, we can see that it is the semiconductor, solar, the Mag 7, technology, financials, consumer discretionary, industrials, China tech, communications outperforming the S&P 500. And of course, when the markets are rallying and when the markets are risk on, gold tends to underperform. What is happening with the S&P 500 right now is just in line with historical data. Let's look at this chart here. Percentage of times a sector outperformed the S&P 500 after a 10 to 20% correction. We can see here the infotech sector, right? XLK, SMH, right here is the clear leader. And it looks like we have still legs to run in the next months. We are just at day 42 after the 18-19% correction in the S&P 500. The other sectors you could consider consumer discretionary, financials, and industrial sectors, right? So for the local market, some movements in the index could be influenced by the MSCI rebalancing, which will be finalized by May 30. So for the standard index, no additions or deletions, but some weight adjustments on JFC, ICT, BDO, and BPI. Surprise addition for AEV, a massive inclusion on the small caps with Bloom and Wilcon being deleted. So for on the AEV charts, AEV gapped up 10% last week. Now, if this pullback results into a gap fill or maybe even a 34.65, could be a good pick up, a good quick trade for AEV. Also, surprisingly, despite the negative news, Bloomberry has managed to stay within the support level at 4 pesos. It looks like the stock has capitulated, and with heavy volume in the past weeks, the pullback after the index deletion could be a good swing trade for the technical rebound. Although markets have settled considerably in the past week, potential disruptions remain on the horizon. The grand plan of Trump was to have every line buzzing with trade talk from every nation on earth, with locking in 150 trade deals at once. But as it turns out, negotiating even 2 trade deals was a heavy lift for the Trump administration, and time is running short, right? So instead of negotiating, the US will probably just send out a mass newsletter or a bulletin, no, telling the world exactly what it will cost to ship goods to America, right? No back and forth required, right? These new tariff rates for trading partners within the next few weeks could be unpredictable and could rattle investor confidence. And China was right in saying that the 90-day US tariff truce is just too short and should be extended. So we'll see what happens there. Meanwhile, Moody's downgraded the US sovereign credit rating from AAA to AA1, marking the loss of its final top-tier rating among the three major credit agencies. This decision was driven by concerns over the nation's escalating debt, persistent fiscal deficits, and rising interest costs. No? This follows similar downgrades from Standard & Poor's and Fitch due to similar reasons. No? As a result, the US 10-year yields ticked up to a high of 4.49 before closing the week at 4.45. No? So Moody's projects that the US federal debt will be 134% of GDP by 2034 from its current level of 98%. Remember that interest rates have risen over the years, and the aggressive borrowing since the COVID era has further increased the cost of servicing this debt. Historically, the S&P 500 rallied after the S&P and Fitch downgrades. So maybe the index could push up higher to the 60-43 resistance area this week, but we'll see, right? So for this week, mixed performances from Philippine stocks. Some issues rallying, some issues pulling back. For example, AC pulling back 4% last Friday, while SM managing to hold its level. Some will go up, some will go down. Overall, the trend for the PSEI is still bullish. Watch out for a possible retrace to 6.3, where you can do some bargain hunting. Again, the US-China trade truce, no, is just for 90 days. Let's see what happens, especially after Trump, no, begins to announce some trade deals, no, in the coming weeks. Again, we need to look at the numbers for May, right, which will happen in June. We have to look at the inflation numbers in June. We have to look at the inflation numbers in July for the US. Tariff effects have not been priced in yet. And you know, when they say that you have to be cautious, no, you have to be fearful when the market is greedy. The market is greedy right now, but based on some of the macroeconomic trends, we need to exercise some caution that this may just be the calm before the inflation storm in the coming months. If these numbers come in worse than expected, gold could make a comeback in the next quarter. So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Manage your risks accordingly. And I'll see you again next week. Bye-bye.